All right, thanks everyone for joining us today. I'll let Lowell kick us off.
I echo Andy's thanking you for joining us. 2022 was a dicey year. We had just gotten past the COVID crisis, Russia invades Ukraine, and inflation spikes causing the Fed to take aggressive tightening action. The market responded to that as expected, but the year finished strong, primarily due to inflation responding to the Fed's actions. Nobody looks forward to a year like 2022, but that type of market creates opportunities for active investors. As a result, on a relative return basis, we posted for our equity strategies our best returns in 20 years, and our asset allocation models posted similarly strong results. This sets us up for a recovery period ahead, which is another type of opportunity that we'll cover a bit later. Ben is going to do his review of asset class returns and cover some key macroeconomic data. And then Andy will do a deeper dive into our core equity strategies and what we expect for the year ahead. So Ben?
Perfect. Thank you, Lowell. So usually when you get kind of kicked off on these quarterly webinars, we're going to do a broad review of the asset classes for the recent quarter and their respective returns. So excuse me, as Lowell mentioned, 2022 is a dicey year. So the past few of these quarterly updates, we've seen a lot of red on this sheet here. So it's nice to see some green, some wins across the board. So on the stock side, a lot of fairly even, with the outlier really being the international developed stocks that stick out on that front. A lot of that is probably to do with expected inflation on the international side versus what actual came through, especially with the energy crisis and a couple of those other things that panned out a little bit better than they were expecting. So they had a bigger pop in Q4. Kind of going over the bond market, again, a historic year over there, which we'll touch in a second, but nice to see some life coming from the fixed income side, especially on the US bond market piece. So kind of focusing a little bit more into the long-term market. So we can see that in 2022 was a year of correlation to the downside. So obviously that one-year number across the board, no matter what asset class you're in, you're headed down. So really a big piece to kind of focus on is, again, the relative performance between international developed and the rest of the equity pieces held, because they were able to kind of kick back a little bit more in the fourth quarter. Again, on the bond market side, historic year, double-digit correction in the bond market, along with a correction and bear market in the stocks in the US market. That was the first time that's happened in the history of the market, really. So kind of big piece to focus on as we bleed that more into the longer term approach that we want to be looking at, the 5 and 10 year, a lot more green across the board, with the US stock market really leading the charge on a bigger disparity there. So the next piece we'll look at is it's kind of a quilt chart that we put together. And this is something we've shown in previous quarterly reviews we've done. And it really just kind of reminds us on the importance of diversification and not really just chasing the most recent asset class in particular that's stuck out. So we can kind of see the big winner for 2022 was managed futures. And a lot of our asset allocation clients will recognize that, because it was really a placeholder that was in there that was outside of the traditional stocks and bonds that we've seen. So a particular traditional 60-40 portfolio, obviously we know how both US equities or equities in general and bonds both did last year, again, correlated to the downside. Managed futures was able to be an alternative asset class that really stuck in there to kind of limit volatility on that side of things. So again, it's nice to see things like commodities rear its head for a couple of years in a row, where they spent previously the rest of the last decade toward the bottom of the sheet here, going back to 2012. So just kind of a quick highlight on where things are. Andy's going to touch on a little bit of where large cap and small cap and how they kind of touch on pretty similar from those two classes there. So now we can really focus on what really the bigger story of the year, which was inflation versus interest rates. So obviously we kind of started the year hot, month over month, year over year. Inflation really until midsummer was scorching, and I'll show you in a second that the Fed was kind of late to the game. This time last year, the news was inflation is transitory, nothing to be worried about in the long term. And, in order to kind of catch up, they really had to be more aggressive. So we really see inflation take a huge ride up until about midsummer. and then it starts to really creep down because the Fed really was able to kind of catch up and get in front of it a little bit. Something to note here is as we kind of ended the year on a downward trend, is very positive news that we want to look at. A big piece of that is included in this is core inflation, which includes all the various pieces, including shelter or rent. And that's a little bit more of a stickier side of inflation. So if we were to exclude that from this chart, it would look much better on an inflationary standpoint as we head into the end of the year. So obviously the long-term target the Fed has, they still want 2.5% long-term inflation. They still have a little bit of a while to get there. But as we end the year in a downward trend, that's some really positive news that we want to focus on. So the next piece is the other side of that, which is the interest rates. So we know that, as I said, we got to March where the Fed didn't really touch much. They really got ramped up, 50 basis points hike right out of the gate, and then went up 75 basis points for multiple months in a row, where we really hit the year. Heading into December, that was the first time they really cut it back a little bit. So they went from 75 basis point hikes to 150 basis point hike heading into December. And then kind of looking forward into this year, the expectation is just 2 more rate hikes, 25 basis points each, and then kind of in a holding period. And really they were able to, as we saw inflation ramped up and came back down, the Fed never really let off the gas. So they were able to kind of get in front of us a little bit. The Fed was able to tailor it down a little bit. But in reality, it felt like a year where it was a shot for interest rates, and it was the talk of the town. Mortgage rates are going up. Everything is really going up. It's harder to borrow money. But if we take a bigger picture approach, and there's a saying that says, when in doubt, zoom out, kind of see where we were and interest rates are now compared to what they have been over the last 70 years or so. So something to really focus on is we were coming off historic low rates. Even back in after the 2008 crash, we were pretty close to the bottom, under 2%. And then we started to creep back up, and COVID really struck that. And if we took out COVID, you can kind of see the trend line would have really met up with where we are today in terms of rate hikes. It's just a little bit different way of getting there. But the other thing to kind of focus on is, inflation, if it takes a little bit longer to come down and we can leave rates at 3 or 4% above what the average was over the last 15 years, we're gonna have certain products out there, your money markets, cash, for instance, in the bank, short-term bonds, those are more viable options than they have been over the last 15, 20 years or so. So that's something to really kind of focus on from that standpoint. And again, a lot of people say, what's the long-term rates? And then usually 4% is a number that gets thrown out there. There's only really been one point in time over the last 70 plus years where it actually sat at 4%. And that was really back in the 50s here that we'll see, where it actually sat at 4% for a couple of years before, a recession kind of came into gear. So again, kind of looking at this chart, each gray line is a recession that has been in line. And you can kind of see where rates start to peak and recession comes in, and then we start to see those rates come back down. So the issue with 2022 is that post-COVID, we cut rates to 0 and the Fed didn't really have any tools in their belt. So as there's a lot of talk on, are we hitting a recession in 2023, 2024? What does that look like? With inflation coming down, rates still remaining in the 4% range, there's been a lot more talk about the soft landing and the Fed is trying to attempt to accomplish. And 6 months ago, it didn't really look like it was in the cards. It's becoming a little bit more, evident that it might be, I'll call it a water landing. Maybe not as soft as we hope, but it's going to be a little rough. But there's more tools in there, and then it may line up with some of these recession lines that we've seen historically when rates seem to peak over time. So kind of just, again, macro piece of what we're looking at in the market kind of headed this year. But again, the focus is, short-term money markets, things like that are really going to be more viable options for savings, than they have been over the last 15 years. So kind of moving into a separate topic, kind of just a reminder, Andy and I did a webinar 2 weeks ago that was just kind of updating on everyone where we were in 2022 and kind of focusing on 2023. And there's some public policy changes that came in and just inflation adjustments to retirement plan contributions. So this is just a reminder, if you have not seen that webinar, we did a lot of updates on how the Secure Act that was passed in December of 2022, how those changed certain pieces of retirement planning. Just wanted to remind everyone that if you haven't seen it, go watch that. And then always reach out to your advisor on how those changes may affect you. So with that, I'm going to hand this over to Andy, and he's going to touch more on our strategy in particular and a little bit more of the investment side of things.
Yeah, thanks, Ben. And I think everyone knew it on the call, but those tables you're showing with those big red numbers certainly were ugly. And, it was the case for virtually all asset classes last year that things were down. But sometimes those headline numbers really kind of distort what's going on under the hood of an asset class. And, I think as the people on this call know, our U.S. equity investment strategy really aims to take advantage of this under the hood action by tilting to the size and style phase of the market expected to outperform ahead. So we're going to switch now to some more specifics about our investment strategy. But first, when we look at small caps versus large caps, they're actually really, the headline number was pretty accurate. There's really no big difference all year long between large and small. They were highly correlated. You can hardly tell a difference between the two return streams. They basically hit right on that return number that you showed earlier. Sometimes, and this maybe would have been our expectation if you told us that there's going to be a big bear market in 2022, but it's usually the case that small cap stocks underperform large caps during a big bear market, but we really didn't see that at any point last year. Totally different story for value though. So the blue lines here on this chart are your value stocks and the gold lines are your growth stocks. So you can see whether it was large caps or small caps, the value cohort outperformed the growth cohort. It was especially pronounced in the large cap space where we saw large value down just 5%, not even a market correction at the end of the year, whereas growth was down nearly 30%. And I think that we kind of got used to the storyline over much of the past decade where it was the mega cap growth stocks. I'll use kind of at this point, dated reference, but the FANG type stocks. We got so used to those outperforming. So that storyline suddenly flipped in the last year. And what that resulted in is, we can feel pretty confident that we are firmly entrenched in a pro-value market phase at this point. So I often share this chart in, these quarterly webinars. But just, a quick reminder, I call this the wave chart. And basically what we're looking at here is, are we in a value phase or a growth phase? So the blue, whenever you see blue on the chart, it just means the past year, value outperformed growth. When you see gold on the chart, the past year, growth outperformed value. And you can see that we've got a pretty substantial, value outperformance here. We're basically trapped right at a year. In fact, it's a pretty extreme value. The difference is kind of hard to pick up on this chart, but it ticks just below that 25% mark. The difference between growth and value was 24% over the past 12 months. And, when you look historically, that's actually higher than the typical peak that we see in a normal value phase. The one exception, of course, is the .com era and the bubble burst that followed. We saw much more, much stronger pro-value performance during that time frame. So, I think it's actually a pretty reasonable question to ask. Okay, hey, we saw value outperform over the past year, but has that move already happened? Is there still juice left to squeeze, so to speak, for value? And we think there is. And there's really three reasons why. First, when we look at value phases, these tend to be measured in years, not months. So the fact that we're about at 1 year of value outperformance doesn't mean that this value phase is necessarily long in the tooth. There still could be, looking back historically, there still could be time left for the phase. And the second one is momentum. Momentum, once it's established, can be self-fulfilling. And so a simple but effective rule of thumb to use for this is when you're in a certain phase, expect that phase to continue. So since we're in a value phase right now, our expectation is that value stocks are going to continue outperforming. And really the third reason is when you look at the relative valuation space, there still seems like there's lots of room to go. So this is a chart that we've actually shared before. It's not our own. We borrow it from the asset management firm AQR. And it's a similar look at, if we take value companies as a group and we compare them to growth companies as a group, where are they in terms of relative valuation? So we'd expect them to be somewhere closer to the origin of this chart, but we're still more than 2 standard deviations away from the norm. So even after this big pro value move, things have been so out of whack for so long, there's still plenty of room to go and get back to something that looks more normal. So when you've got the fundamental case and the momentum case, it makes sense to stick towards value. And one thing I wanted to point out here is the last time we saw such extreme valuation dispersions between growth and value was, again, that dot-com bubble burst era, and the value phase that occurred at that time lasted 7 years long. So, the typical, we would expect it to last a couple years, but 7 years is much longer than normal. And so this isn't to say, obviously the situation today with growth companies is very different from what it was back then. You can't directly compare any 2 eras, but it is interesting to note the last time we saw such wide valuation dispersions, we had a longer than normal pro value phase. So where we are today is we came into the year at this weighting, and we're still at this weighting. We're leaning in towards value. We're positioning our portfolios here. So whether you're invested in the SSR strategy or the master strategy, your portfolio tilt is going to look something along these lines. One thing to note, we never go 100% one way or the other, pro value or pro growth. So we still do have an allocation to growth companies. We do that to make sure that we remain fully diversified and have exposure to all sorts of asset classes out there. But we are tilting pretty substantially towards value, and we don't expect that to change anytime in the near term. And in fact, we expect this positioning to be a tailwind for portfolios going into the new year. So we always start talking about size and style because that's really the most important component of our investment strategy. The truth of the matter is, no matter how good your stock picking skills are, if you're fishing in the wrong size and style bucket, you're going to have a really tough time generating strong returns. But that isn't to say that stock selection isn't important. And in fact, today, there's above average return potential from stock selection. So you've heard us talk about this if you were with us back in 2020. We touched on it back in June, most recently in these quarterly webinars. But it turns out when you look back at past bear markets and the ensuing recoveries, the type of companies that do well in the recovery phase of the market are fairly predictable. In fact, remarkably so. I won't go into too much detail as to what goes on under the hood here. We did cover this in more detail back in June. I also have a blog post posted on burningwealth.com that you can reference as well if you want a little bit more information on recovery score. But basically, we take our standard stock selection methodology and modeling process and just simply apply it on past market recovery phases rather than normal market phases. And the results of doing this have been extraordinary when we get the opportunity to turn them on. The key insight is basically the stocks that are the most oversold in the bear market tend to be the ones that do the best when stocks do recover. So in practice, the way that we actually implement this is we take the stocks that this recovery score model says are viable, and we cross-reference them with our standard modeling process. And that way we end up with a portfolio that has the opportunity to take advantage of recovery score and lean into these types of oversold companies while also ensuring that we're buying companies we can live with over the long run. The scores is more of a quality biased metric. So these next 2 slides here are slides that you'll recognize if you're with us back in July at the webinar, but this was the most recent time we had a chance to turn recovery score on, and it was highly effective. So you'll note here that there were 2 big months. The first one here in April of 2020, that was that big rally month after the market bottom. And then the other one was in November of 2020. And if you recall, that's when we got the news that vaccines were coming and the market really rallied. But even if you exclude those 2 huge rally months, you can see that the stocks that recovery score said to buy outperformed the rest of the group virtually every month throughout this phase until it petered out somewhere around the spring of 2021. And so when we talk about our expectations for recovery score this go around, we may not get these gigantic April or November months here, but this is plenty of return potential. And that's what we want to lean into this go round. So that's kind of the most recent time. It was highly effective the most recent time we had a chance to turn it on. But this time, we shared this chart last time too. I've updated it with data to get through actually even into January. And here we're seeing, once again, we're seeing recovery score perform as we expected. We talked about a weird quirk. We were watching this signal in June, in really the first half of the year, and it wasn't performing the way we'd expect it to. We would normally expect recovery score to be a double-edged sword. That is, when we have a strong month, we would expect it to outperform. But when we have a down month in the market, we would expect it to be inverted. That is to say, the stocks it recommends buying should perform worse in a down market. And so we didn't really see that so much until we get to June. And so you might recall us talking about in the summer that we've turned on the model, but we're going to be cautious with its implementation because we're not seeing it behave the way that we expect it to behave. And our intuition for that turned out to be pretty good, because in September, once again, we saw the market retest those market lows for the year, and recovery score finally began to perform as we'd expected. It was highly inverted in that down month, and then in the up months, we saw it remain effective, where the buys outperformed the other groups. The one down month of December, it performed as expected. So this gives us more confidence now that we're finally seeing recovery score perform the way that it should. It gives us more confidence that we can turn it on. And so you'll probably, we've already begun to do this in our portfolios, and especially in the fourth quarter. But now that we've got a new tax year and in taxable accounts, we'll be a little bit more aggressive about the implementation of this stock selection model, because we think this will be an important driver of returns when we do get a sustained market recovery. And so as we wrap up our webinar today, I wanted to leave everyone with an offer. And this is something that we mentioned in our quarterly letter that we sent out to all of you. But it was an extraordinarily difficult year to make money last year. It didn't seem to matter what you were invested in. If you were in the most speculative, piece of the market, whether that be the COVID darling stocks or cryptocurrencies, you were down 60, 70%. Or even more, depending on what you were invested in. But even if you were doing the responsible thing and you were investing in something that's maybe more like a 60-40 moderate risk profile type portfolio, you were still down double digits because bonds entered a bear market at the same time that stocks did. So we really didn't get that protection there. It was an extraordinarily difficult time, but there are other options out there. And so whether you're focused on growing your assets or protecting your assets, we are offering a portfolio analysis here as we kick off the new year to analyze any outside holdings you have, and give you feedback on how you're currently invested. So I think as Bernie clients, we know that having a sound investment strategy is important to you. And we've already seen clients begin to take us up on this offer. So if you were disappointed in the performance, or even if you weren't disappointed, you just want a second opinion, we are offering this portfolio analysis to offer that second opinion here in the new year. So if you want to set that up, reach out to your advisor, or you can contact us at either this email address or that phone number here on the screen. With that, I think I was talking to Ben before, and as I was saying, we normally go a little bit long in these first webinars of the year, but I think we saved you guys a few minutes on your afternoon. So if you do have any questions that come up, please feel free, again, reach out to your advisor, reach out to us and any of these channels here. And we appreciate you joining us today.